Welcome, my friends. The news that Moody's Analytics has cut ratings of 10 U.S. banks and put some big names on downgrade watch. Among the smaller lenders receiving an official ratings downgrade were M&T Bank, Pinnacle Financial, Bach Financial and Webster Financial. Major lenders Bank of New York Mellon, U.S. Bancorp, State Street, Truist Financial, Cullen/Frost Bankers and Northern Trust are now under review for a potential downgrade. Banking turmoil is taking another step up. You probably recall that, just a couple of weeks ago, Heartland Tri-State of Elkhart, Kansas has failed and was sent into receivership by the Federal Deposit Insurance Corporation, FDIC. As you probably recall, a number of banks have failed so far in 2023. Silicon Valley Bank, Signature Bank, First Republic Bank, Silvergate Bank voluntarily shut down and went out of business. And Pacific West Bancorp was forced to merge with Banc of California just last week. What does it mean for the economy? And, what does it mean for the future of the United States? But, before we get into all of that, please press the like button and leave us a comment below. We would love to hear from you. Please subscribe and hit the bell icon so that you are notified of upcoming videos when they are released. And, before we continue, a word from the sponsor of this video. Today's sponsor is InnerLife.com, creator of the InnerLife STS system. InnerLife STS is a cloud mobile platform for mental health care and its integration with primary medical care. InnerLife STS is designed for assessment, data collection and analytics, documentation, and progress tracking. InnerLife STS creates and composes conceptualized narratives and builds them into professional-grade reports. These reports are designed for use by mental health professionals, primary care physicians, justice system professionals and universities and include mental health assessment reports, mental health treatment reports, and treatment progress reports. And InnerLife STS uses doctor-selected pseudonames for all patients. So, only the healthcare professional knows the patient identity. Moody's cut the credit ratings of a host of small and mid-sized U.S. banks late Monday and placed several big Wall Street names on negative review. The firm lowered the ratings of 10 banks by one rung, while major lenders Bank of New York Mellon, U.S. Bancorp, State Street, Truist Financial, Cullen/Frost Bankers and Northern Trust are now under review for a potential downgrade. Moody's also changed its outlook to negative for 11 banks, including Capital One, Citizens Financial, and Fifth Third Bancorp. Among the smaller lenders receiving an official ratings downgrade were M&T Bank, Pinnacle Financial, Bach Financial and Webster Financial. U.S. banks continue to contend with interest rate and asset liability management, ALM, risks with implications for liquidity and capital, as the wind down of unconventional monetary policy drains system-wide deposits and higher interest rates depress the value of fixed-rate assets, Moody's analysts Jill Satina and Anna Arsov said in the accompanying research note. Meanwhile, many banks' Q2 results showed growing profitability pressures that will reduce their ability to generate internal capital. This comes as a mild U.S. recession is on the horizon for early 2024 and asset quality looks set to decline from solid but unsustainable levels, with particular risks in some banks' commercial real estate, CRE, portfolios. Regional U.S. banks were thrust into the spotlight earlier this year after the collapse of Silicon Valley Bank and Signature Bank triggered a run on deposits across the sector. The panic eventually spread to Europe and resulted in the emergency rescue of Swiss giant Credit Suisse by domestic rival UBS. Though authorities went to great lengths to restore confidence, Moody's warned that banks with substantial unrealized losses that are not captured by their regulatory capital ratios may still be susceptible to sudden losses of market or consumer confidence in a high interest rate environment. The Federal Reserve in July lifted its benchmark borrowing rate to a 5.25%-5.5% range, having tightened monetary policy aggressively over the past year and a half in a bid to rein in sky-high inflation. We expect banks' ALM risks to be exacerbated by the significant increase in the Federal Reserve's policy rate as well as the ongoing reduction in banking system reserves at the Fed and, relatedly, deposits because of ongoing QT, Moody's said in the report. Interest rates are likely to remain higher for longer until inflation returns to within the Fed's target range and, as noted earlier, longer-term U.S. interest rates also are moving higher because of multiple factors, which will put further pressure on banks' fixed-rate assets. Regional banks are at a greater risk since they have comparatively low regulatory capital, Moody's noted, adding that institutions with a higher share of fixed-rate assets on the balance sheet are more constrained in terms of profitability and ability to grow capital and continue lending. Risks may be more pronounced if the U.S. enters a recession, which we expect will happen in early 2024, because asset quality will worsen and increase the potential for capital erosion, the analysts added. Though the stress on U.S. banks has mostly been concentrated in funding and interest rate risk resulting from monetary policy tightening, Moody's warned that a worsening in asset quality is on the horizon. We continue to expect a mild recession in early 2024, and given the funding strains on the U.S. banking sector, there will likely be a tightening of credit conditions and rising loan losses for U.S. banks, the agency said. The banking turmoil of 2023 arrived in small-town America when a tiny 4-branch bank in Kansas failed, becoming the 4th lender to be seized by regulators this year and the 5th to fold altogether. The Heartland Tri-State Bank, of Elkhart, Kansas, is the smallest to go under in 2023 by far. It had $139 million in assets when it went down Friday, according to the Federal Deposit Insurance Corporation. The other banks that failed thus far this year all had assets of more than $100 billion, including Silicon Valley Bank and Signature Bank. The biggest was First Republic, which had $229 billion when it was seized by regulators in May, becoming the second largest bank failure in U.S. history. The failures of Silicon Valley Bank and Signature Bank in March were the third and fourth biggest ever. Silvergate agreed in March to shut itself down voluntarily. It is not yet entirely clear why Heartland went down. The Kansas office of the state banking commissioner said in a release that Bank Commissioner David Herndon determined that Heartland Tri-State Bank was insolvent and that it became insolvent due to an isolated event. Overall, the Kansas banking industry is unaffected by this event and Kansas banks remain strong, the release stated. Heartland is one of thousands of small community banks that serve local areas across the U.S. Most banks in this country are more like Heartland than they are like industry giant J.P. Morgan Chase, which has thousands of branches and more than $3 trillion in assets. Heartland's headquarters city of Elkhart has a population of less than 2,000 people, according to 2021 U.S. Census records, and is located in the southwest corner of the state. Elkhart was among the many towns in that part of the country struck by Dust Bowl storms in the 1930s. Another community bank in that state, Dream First Bank, of Syracuse, Kansas, agreed to assume all of Heartland Tri-State's deposits and purchase essentially all of the failed bank's assets, according to the FDIC. The FDIC agreed to share future losses on loans purchased by Dream First. It estimates this failure will cost the FDIC's Deposit Insurance Fund $54.2 million. The recent closures of First Republic, Silicon Valley Bank and Signature Bank this year have shaken up the banking industry, prompting lawmakers to introduce new legislation to protect customer deposits and stabilize the financial system. Depositors of Heartland Tri-State Bank will become customers of Dream First Bank, meaning that withdrawals, deposits, and loan transactions will be processed through Dream First Bank. Customers of Heartland Tri-State Bank should continue to use their existing branch location until the bank has completed the transition. Heartland Tri-State Bank is the first bank to collapse since troubled First Republic Bank was acquired by J.P. Morgan in May after efforts to rescue the company failed. It also follows the dramatic collapse of Silicon Valley Bank in March that triggered days of chaos in the U.S. banking system. The Heartland Tri-State Bank collapse also marks the second bank crisis of the week. On July 25, PacWest merged with Banc of California, with both banks seemingly looking to shore up amidst the banking industry turmoil. Behind the bank's failures is believed to be the rising interest rates in the United States along with poor risk management from financial institutions. The Federal Reserve increased its benchmark rate over the past year to more than 5.25% in July, the highest rate since 2007, in an effort to curb inflation in the country. In June, the inflation rate in the U.S. was 4.1% year over year. Heartland Tri-State Bank had approximately $139 million in total assets and $130 million in total deposits as of March. Along with deposits, Dream First Bank agreed to purchase all the failed bank's assets. The FDIC estimates that the cost to the Deposit Insurance Fund, DIF, will be $54.2 million. The DIF is an insurance fund created by Congress in 1933 and managed by the FDIC to protect the deposits at the nation's banks. Compared to other alternatives, Dream First Bank, National Association's acquisition was the least costly resolution for the DIF, said the FDIC. Democrats with the House Financial Services Committee have introduced several bills in June in what they described as the first wave of legislation aimed at addressing failures at major banks. The failures of Silicon Valley Bank, Signature Bank, and First Republic Bank make clear that it is past time for legislation aimed at strengthening the safety and soundness of our banking system and enhancing bank executive accountability, said at the time Congresswoman Maxine Waters. Congress must not sit idly by. But, what do you think? Please leave us a comment below and hit the like button. We would love to hear from you. Please subscribe and hit the bell icon so that you are notified of upcoming videos when they are released. Please share this video on social media. Thank you for watching.